Hello everyone, Professor Christensen here. Welcome to this video where we're going to prepare a classified balance sheet along with an income statement and a retained earnings statement. So on your screen you see the information that we have for Chamberlain Inc. for the end of 2018. So here are all of our accounts. In red, I've listed the various classifications that we're going to have both on our income statement and on our balance sheet. And so the first thing that we want to do is classify all of our accounts, which is going to make it much easier for us later when we have to prepare our financial statements. So these accounts are in alphabetical order. Let's go down and decide which classification they're in. Okay, so accounts payable is a current liability. Hopefully you remember that. Accounts payable is going to be paid within 30 days. Recall that a current liability is a liability that we plan to pay within 1 year or the operating cycle, whichever is longer. Okay, let's do accounts receivable and then I'll let you continue on. So accounts receivable, remember, is a current asset. A current asset is an asset that's going to be used or turned into cash within a year. And remember that accounts receivable are amounts that our customers owe us, and generally we're going to collect from them within around 30 days, depending on our credit terms. Okay, so why don't you pause the video for a minute, and this is a great way to review how well you know your accounts. So go down the list of accounts and classify each of them into one of the categories. And then when you're done, come on back and we'll go through together the rest of the accounts. Okay, so hopefully you did a good job of classifying the accounts. I'm just going to go down now and let's decide where all of these go. Accumulated depreciation, hopefully you remember, is a contra asset account. That means it goes against the asset that's being depreciated. Okay, so that goes in property, plant, and equipment along with the related asset. Cash is a current asset. Of course, that's going to be turned, well, it is cash, so that's going to be one of our most liquid assets, right? Common stock is part of our stockholders' equity, the money that we received from our investors. Debt investments, they tell us that they are long-term. So that's going to be a long-term investment, which we'll classify in investments. So that means that you bought the debt of another company. So we don't want to get that confused with our debt, which is money that we owe. When we buy a debt investment, that would be like you buying a bond. So you're buying bonds that another company has issued. Okay? All right, then we have depreciation expense. That is an expense. Dividend revenue. Well, the dividend revenue probably came as a result of our stock investment, which we're going to see in a minute. So when you own stock, you get dividends, right? So that's a revenue. Dividends are part of our stockholders' equity. Equipment is property, plant, and equipment. And again, we have short-term investments here. Short-term investments are part of a current assets because that means we're going to liquidate those investments within a year. Our insurance expense and interest expense are both expenses. Today we're going to do a single-step income statement. Later on, when you do a multiple-step income statement, we would classify interest expense and dividend revenue as other. But for now, we're just going to have a single-step income statement. Okay, inventory is a current asset. Remember, inventory is items that you're going to sell in the future for a customer at a profit, hopefully. Land is part of property, plant, and equipment. A mortgage payable, remember, payables are liabilities, and a mortgage is generally, unless you're told otherwise, a long-term liability. Notes payable, also a long-term liability because they're not due until 2025. Patents, hopefully you remember, are an intangible asset. Patents are rights that you have to sell a product. Prepaid insurance is a current asset. That's insurance that you have paid ahead of time. Rent expense, we know, is an expense. Retained earnings, part of our stockholders' equity. Remember, anytime you see a payable, it's a current liability. In this case, salaries and wages. Of course, our employees are not going to wait more than a few days to get paid after they worked, right? Maybe a week or so. Salaries and wages expense is an expense. Service revenue is our revenue. Supplies is a current asset. Supplies expense is an expense. And then we have unearned revenue. So you might be tempted to call unearned revenue revenue. But remember that unearned revenue is actually a current liability, because what earned revenue is that a customer paid us ahead of time and we haven't done the work yet. So instead of owing money, in the case of unearned revenue, we owe services or goods to our customer. Okay? All right, so now let's get started. Remember, the first statement we always have to prepare is the income statement, because then the numbers from there go into we need our net income for our retained earnings statement. So we're going to put the name of the company, and we're also going to put the date. So this is an income statement for the year ended December 31st, 2018. All right. Okay, so remember, on our income statement, we have revenues minus expenses. So first we're going to put our revenues. And remember, we had two kinds of revenue. One is our service revenue and one is dividend revenue. So obviously the main thing we do for a living is service revenue. Our service revenue is $144,000. So we're going to put that first. Okay. And as I go along, you should check it off on your paper, but I'm going to highlight these accounts as we use them so we don't forget anything, okay? All right, so next up is dividend revenue, which is $100. All right, and then we're going to say total revenue. We're going to add them up. And total revenue is going to be equal to the $144,000 plus the $100,000. All right, next up are expenses. So we're going to put our expenses from the largest to the smallest, because people are more interested in the largest number. So we're going to take a look at all of the expense numbers that we have here, and we need to put them in size order. All right, so it looks like our largest expense is salaries and wages. So we're going to put that one first. I'm going to put our expenses to the left so it'll be clear. We'll add them all up and then we'll subtract the total from our revenue. Okay, so our salaries and wage expense is equal to $50,000. Again, I'm going to highlight that so we remember that we check that one off. All right, our next biggest expense looks like rent expense. So let's put rent expense in next. And our rent expense is $37,000. All right, next is supplies. Supplies expense. Remember, supplies expense is the amount of supplies that we used up. Supplies are the amount of supplies that we still have left, so that's an asset. Okay, so supplies expense, and then we have, it looks like depreciation expense is next. So we're going to take depreciation expense, and that is here. Okay, and then we have insurance and interest, and our insurance is a little bigger. So we'll put that first, and then our interest. Okay, so now we have our total expenses. Let me just highlight all of our expenses so we know that we check them all off. Okay, I think that's everything. All right, so our total expenses is going to be the sum of all of these numbers, and that comes out to $96,250. Now remember, revenues minus expenses gives us net income. So our net income is equal to revenues minus expenses. Also remember that if this number were negative, we would call it a net loss. Okay. All right, so our income statement's all set. Next thing we're going to do, retained earnings statement. Now our heading is going to look very much like our income statement. Our retained earnings statement is for a period of time. And so this, in this case, it's for the year ended December 31st. Now, retained earnings is beginning balance plus we add net income minus dividends to get our ending balance. So our beginning retained earnings is equal to 22,000. Highlight that or check it off so you're not tempted. Oops, I put that in the wrong place. Highlight that or check it off so you're not tempted to use it in the wrong place, which would be on the balance sheet. Okay, so now we're going to add our net income. Our net income comes from our income statement. Oh, my lines are messed up now, but that's okay. Okay, so then we'll have a subtotal. And that's equal to this plus that. All right, let me just fix up my lines because I don't want people to get confused. We want a border line here so we know which things we added and which things we did not. Okay? All right, so beginning retained earnings plus net income. Now we're going to say less dividends. And that's going to give us our ending retained earnings. So our dividends are here. Highlight those. And that gives us our retained earnings December 31st. And that's equal to the 69,850 minus the 1,000. Okay, so now we have checked off everything here except for what goes on our balance sheet, which is our assets, liabilities, and stockholders' equity. So there we have our finished retained earnings statement. Now what I'm going to do is I'm going to just insert a bunch of lines here for a minute so we can have our, I want to move all of these down so you can see them next to the financials as we use them. Okay, I'm going to insert a few more lines. This way we have some space. Okay, so now we'll be able to do our balance sheet. So remember our balance sheet, we're also going to put the name of the company. Our balance sheet is for a point in time. So our balance sheet is December 31st, 2018. And let's move this up now. Okay, so remember what goes on our balance sheet. We have assets, liabilities, and stockholders' equity. And today we're going to classify our balance sheet into the different classifications here. So first we're going to have assets. And our first category of assets is current assets. Okay, so remember that our current assets go in order of liquidity. Our most liquid asset is always going to be cash. So we'll put our amount for cash first. And then let's highlight that so we know we took care of it. Okay, what is our next most liquid asset? Well, it looks like here our next most liquid asset is our stock investments. So our stock investments, remember, how do you sell a stock? You can do it instantaneously pretty much, right? So to turn a stock into cash is very quick. And our next most liquid asset after that is going to be accounts receivable. Accounts receivable is going to take a little time for us to collect, right? It's going to take maybe 30 days to collect it from our customers. So we're going to put equity investments next. And then after that, we'll put accounts receivable. So our equity investments are 2,500 and our accounts receivable. And then we're going to highlight these so we know we finished with those. And our equity investments are next. Okay, so what else do we have for our current assets? Let's see, we have inventory, prepaid insurance, and supplies. All right, so inventory is going to go next. Inventory is next liquid next to accounts receivable. Inventory is going to be 3,200. Let's check that off. Okay, we're also going to have prepaid insurance and supplies. And we can put those in any order. I'll put supplies first just because they're bigger. But they're both kind of small prepaids. And you could really put them in either order. Okay, so let's highlight these. and then we should be done with all of our current assets. Okay, let's see, is everything done? Yes, all of our current assets are done. So now we're going to call this total current assets. I'm going to add these up, and that's our total current assets. Okay, move this up a little. Okay, so next up is investments. And these are long-term investments, right? Because they're not current assets. They are non-current assets, assets that will not be used up within the next year. All right. And we're told that we have our debt investments. Okay, I'm going to just type this in because we know it's long-term. And that's our only investment. Okay, that's the only one. So we're just going to put that by itself here. Those are our investments. All right, next up, property, plant, and equipment. Okay, so generally speaking, we're going to put land first. I'm going to put it over here because we're going to have to put the equipment and its accumulated depreciation. So our land is 20,000. All right, and then next we're going to have our equipment. I'm putting the equipment over to the left because I want to put the accumulated depreciation with it. Remember, accumulated depreciation is a contra asset account. It reduces the equipment account. Okay, you can tell something by looking at these numbers also. One question we might ask is, well, how old is our equipment? Well, our accumulated depreciation is 5,000 and the cost is 25,000. So that means we've depreciated it for 20% of its life. Okay, so we know that it's not too old, the equipment. All right, so now this is equal to equipment minus accumulated depreciation. Again, we have 20,000. This is going to be total property, plant, and equipment. And that's equal to these two. And that's 40,000. Okay, next up we have intangible assets. And we had only, let me just highlight these real quick so we don't forget anything along the way. All right, so our only intangible asset is patents. And our patents are 3,200. Okay, so those are all of our assets. We're going to add up each of the categories and I'll get our total. Those four, 109,750 is our total assets. Okay, so now what we hope is that when we get to our total liabilities and stockholders' equity, we get the same amount. Okay, so next is liabilities and stockholders' equity. And again, we're going to start with our current. So in this case, current liabilities. Current liabilities are any liabilities that we plan on liquidating within the next year. So let's see what we have here. We have accounts payable. And let's see, our only other current liability is unearned revenue. No, salaries, wages, payable. So we have three. All right, so unearned revenue is 2,000, salaries and wages is 1,000, and our accounts payable is 2,500. So let's put accounts payable first. I'm going to highlight that. All right, next we will put our unearned revenue. Remember, unearned revenue means we owe customers services. They paid us ahead of time. And then we have our salaries and wages payable. And that's going to give us our total current liabilities. Okay, so we'll add those three up. That gives us our total current liabilities. All right, now we have long-term liabilities. Okay, so what kinds of long-term liabilities do we have? We have a mortgage payable, and a notes payable. So let's put the largest one first. We'll put notes payable, and then we'll put mortgage payable. Okay, so our notes payable is 13,400 and our mortgage payable 10,000. And then let's highlight these. We took care of all of these. All right, so pretty much the only thing left on our list now is common stock. Okay, so we're going to add up our long-term liabilities to get a total, and then we'll put in a total for liabilities. You would want to know how much money a company owed to other companies, right? That's an important number. Okay, so next up, let's do our stockholders' equity. And we have common stock. Remember, we said that was the last one that had not been highlighted up here. So that means our list is all done. Okay. So our common stock is, sorry that I'm scrolling back and forth. I hope I'm not making you dizzy. All right, and then we have our retained earnings. Don't forget, take your retained earnings from your retained earnings statement. Do not take it from the list. If you do, you're going to have the wrong number and your balance sheet won't balance. Okay? Oops, so that was supposed to be equal to that. All right, now we're going to add these two up and get total stockholders' equity. And that is these two added together. All right, and now we have total liabilities and stockholders' equity. And that is equal to, of course, our total liabilities plus our total stockholders' equity. Okay, so we're happy now. The reason we're happy is that our balance sheet balances. Okay, we have total assets equal to 109,750. Total liabilities and stockholders' equity equal to 109,750. All right. And then by way of review, remember that the retained earnings number, let's make it orange, the retained earnings number is the same retained earnings number as our retained earnings statement. Okay. So the retained earnings on our balance sheet comes from our retained earnings statement. And then finally, remember that our net income, we'll make it blue. Our net income from our income statement is the same net income that goes on to our retained earnings statement. Okay? All right, so we have a complete income statement and statement of retained earnings here. Okay? And then we have, we'll do half of our balance sheet at once. There's the first half of the balance sheet, the assets, and then the liabilities and stockholders' equity. Okay? All right, so that's a classified balance sheet. I hope you find this helpful to your studies. Have a great day.